the chapter 8 for you. Then
Thank you
probably
so much, so for that.
tell me, please. Excuse me.
I said thank you so much because of that. You said I will do my best for
Of course.
you too.
Yes, yes, for
I just
sure. Thank you. Okay. As I said to you, today we have the international financial systems. I will give you some information. Last lecture, I have, of course, before the last lecture we had some problem. And last presentation was the exchange rate, the impact of the exchange rate on the inflation and the wages, the impact of these three wages, inflation, interest rate, how it is affecting and changing the all together in the exchange rate, the X rate, so-called the international currencies, how it is affected and how it is affecting our currencies is already introduced to you. And today I will give you some more to the international financial system, which is a little bit more comprehensive explanation of the former class. I will share the slides and start the presentation. If you have any question, please do not hesitate to ask me. Okay, you see probably the slides. I have,
I don't have a question about the slides, but just I needed to know about information that we should get prepare ourselves before exam, because we need to know about some information that they may be more important, and we should get prepared about them to the exam. I need some information from exam in
for,
advance.
for sure, after the class, I will give you detailed information. Okay, don't worry. After this presentation, then I will give you more comprehensive explanation and information about the exam, and I will tell you what we can do. Okay?
Sir, I have one
Okay.
question.
Yes, please.
Will you send us a slash of the course?
It is, of course, it is uploaded to the system. You will see on the queues. But let me finish my presentation, and I will give you the detailed information and the everything. Okay?
Okay.
Okay. As I said to you, today I'm going to introduce you the international financial system, the exchange rate market, the international impact of the X rates, so-called the impact of the foreign currencies on the economy, on the international transactions and trade will be given to you, how it is affecting our economies, our banking sector, how it is affected, our currency, how it is become affected. Results of these activities in the international market will be introduced to you. And in this chapter, we will examine the international financial transactions, as I have mentioned to you, the structure of the international financial system, how it is affecting our monetary system or the monetary transactions in the whole economical structure will be briefly introduced to you. The learning objectives for this class, for this lecture, is going to be introduced to you the impact of the sterilized and unsterilized interventions on foreign exchange market, which means either it is included or not included, these interventions. With interventions or without interventions, sterilized is somehow is not the right, probably the expression, but the interventions which is going to be used by the governments for affecting the foreign exchange rate, so-called the PEG or the flexible or floated exchange, fixed or flexible exchange rates will be then questioned in this class and in this lecture. And this is then somehow it is given here from the book. It is as sterilized or unsterilized, which is not the right, probably the expression. I will prefer to use the interventions which is done by the government for being able to control the foreign currencies or the market, the stability of the market, not letting the stagnation of the market results of this higher appreciation or depreciation of the currency, so-called the changing of the inflation and the devaluating currency or devaluation of the currency may create some problems in this regards, which is somehow will be maintained by using these interventions. They interpret the relationship among the current account, the capital account, and the official reserve transactions balance will be introduced too. They identify the mechanisms for maintaining a fixed exchange rate and assess the challenges faced by the fixed exchange regime. And we will then summarize the advantages, disadvantages of capital controls. The assess the role of the IMF, so-called International Monetary Fund, as an international lender of the last resort, which is assumed to be in our country. The lender of the last resort is the central bank, and as in an international market, we are considering these institutions, I mean, International Monetary Fund, World Bank, and some other institutions, which are offering some financial assistance and ability to give some financial, let's say, contribution for maintaining stable and let's say balanced economical structure and financial markets will be then questioned. The identify the ways in which international monetary policy and the exchange rate arrangements can affect domestic monetary policy operations. And then we will summarize the advantages again, the disadvantages of the exchange rate targeting, which is a very important issue regarding to this issue. As you know, the exchange rate targeting regime is the central bank issue, which tries to ensure nominal exchange rate stability vis-a-vis the currency of so-called anchor country via interest rate, the nominal interest rate changes, and the direct foreign exchange rate interventions. And then this will then somehow supporting and balancing the economy, so-called the importing price stability for the countries expected regarding to this exchange rate targeting. The foreign exchange rate intervention and money supply is becoming, as you are understanding, most important issue. On the one side is the money supply, which is very important for the country, for the domestic market. On the other side, the foreign exchange interventions. Either you are going to intervene to the market for balancing this stagnation and changing the economical structure by using these foreign assets and foreign currencies. As you are observing currently in our countries, also we are having heavily foreign exchange rate, and impact to the economy is becoming very heavily observed. The inflation, as you see, the prices going up because as much as the foreign currency becomes appreciated, the ability of the producers for maintaining the stable prices is becoming very difficult because we are unfortunately most of the emerging economies dependent to the foreign currencies, foreign inputs, foreign energy, and results of this input usage. We are requiring some foreign currencies, and when we are buying these foreign currencies, we are deliberately appreciating these currencies for maintaining our production operation process, and results of this, our money supply is affected and the economical structures becomes also similarly. And as you see here, from the financial system, from the Federal Reserve System, also called the central bank assets, is going to be affected also, because as much as you are issuing and distributing these currencies to the foreign market, your currency becomes negatively affected. Yes, please. I'm listening.
We don't see the slash.
Oh, really?
Yeah.
Oh, why? Thank you very much for warning me. Okay, let me check. What was the problem? I will try to find. Probably I didn't share, or it is not properly shared. It is sharing, but why you're not seeing? I don't understand. I already shared. I stop it and share it again. But you in the beginning of the class, you were seeing.
Yes.
And it is suddenly disappeared. Probably I enlarged it to the whole screen and it is somehow disappeared. Okay, I'm going to share it again. And if it is again, then please remind me, okay? Please warn me, then I will do it again. Okay, as I said to you, we have already mentioned these objectives, learning objectives. I suppose you have seen this, and the interventions that I have mentioned already, I have given to you regarding to the foreign exchange rate and the domestic market, the impact to the money supply and to the Federal Reserve System, so-called the central bank, which is the lender of the last resort in our countries. And as it is mentioned, the IMF, World Bank are the international lender of the last resort for the countries for becoming, let's say, member of the institutions or becoming a part of these institutions for requesting some financial assistantship. And as I said to you, this Federal Reserve System, or so-called the central bank in our countries, is the highest organ, is the highest institution which the banking sector, banks, some loan sharks, some other insurance companies and other institutions and intermediaries who are dealing with this money, dealing with this capital, will then knock the door of this central bank for requesting some assistantship or some bailout program for maintaining their existence. Otherwise, this will then becomes expanded to the other countries. And results of this, then we will then go to the IMF, World Bank, and other institutions for helping hand to the country. Therefore, in the country's level, the Federal Reserve System is very important. As I said to you, as a central bank, is helping hand for controlling and maintaining the foreign assets, as you are observing, is the international reserves and the currency in circulation, which is the liabilities of the countries. And it is supposed to be balanced. If it is not, then if it is somehow problematic, then this will then create some problem to the economy, because as much as your foreign assets is then balanced as and it is somehow not creating any problem, then we don't exist, we don't create any much difficulties to the financial sector. But unfortunately, most of the banking sector who are dealing with these production operation process, who are helping and so-called, not dealing, who are helping and assisting and giving some capital to these institutions, to these companies, are always exercising some problems. If there is some corruption and some undesired expansion and enlargement of the, let's say, reserves, then this will then create problem to the institution, to the banking sector, to this institution in the economy, in the financial system, and this will then create some problem. Therefore, this is supposed to be, this must be controlled and supposed to be very important issue for the central bank and for the economy, because we have to balance this and we have to control this capital market as much as possible in the, let's say, balance and the desired level. These interventions, as I mentioned to you, if it is not in desired level, it is not really contributing for maintaining the sustainable banking sector, then this will then cause some problems. And as a lender of the last resort, the central banks purchases some domestic currencies and corresponding sale of foreign assets in the foreign exchange market lead to an equal decline in its international reserves to the monetary base. Central bank sales of domestic currency to purchase foreign assets in the foreign exchange market results in an equal rise in its international reserves and the monetary base. As I mentioned to you, this is very important for balancing this mechanism for maintaining sustainable financial system in the economy. Are you able to see these slides now?
Yes, yes,
Okay,
sir.
okay, thank
Seeing.
you. Intervention.
It is.
Is okay, Said, you said.
Yeah, it was obvious for me since you start the class. I could see the slides.
Okay, okay, thank you. Intervention in the foreign exchange market, then unsterilized or so-called the government which is not intervened to the market, foreign exchange intervention is not realized, and unsterilized intervention in which domestic currency is sold to purchase foreign assets leads to a gain in international reserves, an increase in the money supply, and depreciation of the domestic currency is expected. And as you are seeing on the graph on the figure, when the purchase of any, let's say we are in the United States, the dollars or any currency in domestic currency decreases the monetary base and the money supply rising domestic interest rate because of this decrease, then because reduction on the money supply will then shift the interest rate for collecting some more capital to the system, isn't it? Because in the banking sector, it is always so. If you have some problem, if you don't have sufficient capital and reserve and let's say loanable fund in your account, then you have to shift the rises to the upper level to promote the people who are saving in the banking sector for increasing their saving rates or percentages for enlarging this capital in the market. Therefore, rising these interest rates and shifting the demand curve to the right, as it is observed in the graph, because supply is supposed to be, as you're observing, is not affected from this exchange rate, but the demand is heavily affected because demand is very because supply of this currency is dependent to the central bank, and the demand is affected, and results of this leading a rise in the exchange rate from E1 to E2 because of this shift. Because as I mentioned to you, shifting the interest rate is also cause some price shifts. It also cause some inflation results of this, or vice versa. This is happened. Either inflation cause interest rate, or if you shift the interest rate, then this will then shift the prices, vice versa, as I mentioned to you. And results of this, then interest exchange rate is expected to increase from E1 to E2. And this intervention in the foreign exchange market, which is supposed to be sterilized foreign exchange intervention, is then the central bank assets will then become somehow to the assets. And as you see, the foreign assets will become 1 billion, and the government bonds, which is issued for collecting some capital, will then becomes collected and let's say saved in the banking sector, and the liabilities which is supposed to be circulated is then becomes zero because you increase the interest rate, and results of this then shift this to the upper level and cause some collection of the capital. Either you are shifting the interest rate for increasing, or you issuing some bonds for collecting this capital into the banking sector. To counter the effects of these foreign exchange interventions, conduct and offsetting open market operations, because open market operation either used for expansionary money policy for enlarging the amount of the money in the system, or contractionary money policy for collecting money from this market. And this is done for collecting and enlarging the market in the financial market. There is no effect on the monetary base and no effect on the exchange rate, as it is mentioned. The balance of payment bookkeeping system used a record all receipts and payments that have a direct on the movement of funds between a nation and foreign currency. The current account, so-called international transactions that involve currently produced goods and services, and the trade balance is supposed to be subjected, and the capital account, the net receipts from capital transactions. This is then the sum of these two is the official reserve transactions balance, which contribute to the balance of payments. The global should we worry about the large use current account deficit is then questioned. The persistent trade, so-called the balance of payment deficits, are a concern for the several reasons. As you know, the balance of payment is mostly dependent to the export-import. If it is negative, then it is negative. If it is positive, then if it is positive. If you have more exportation than import, then this will then positively affect this balance of payments. And if it is more import than export, then this will then negatively affect. Therefore, first, it indicates that the current account exchange rates foreign demand for US export is far less than the US demand for foreign goods, And second, a current account deficit means the foreigners' claim on US assets is growing. Therefore, as I mentioned to you, this is then affecting these international transactions, whether it is incoming or outgoing. If it is incoming, then this will then positively affect this balance of payments. And if it is outgoing, if it is reduced, if it is distributed, if you have transactions more than your incoming assets and reserves and capital, then this will then negatively affect it. And exchange rate regime in the international financial system then is very important. Is of course fixed exchange rate regime, floated exchange rate regime, and managed float regime, which is the dirty float, so called. The fixed is somehow you are peg the currency in a certain value, and this will then somehow maintain this currency as it is. Your currency is not changing, is not affected from the foreign stagnation. This is somehow good because you try to reduce the impact of the foreign currencies on your domestic currency, because when you are pegging, for example, if you peg the UK pound, this will then reduce the demand to the UK pound, because you know that when you are buying this UK pound, you will sell it at this level. For example, if it is currently 22 Turkish lira and it is pegged to 15 Turkish lira, then people who are trying to buy UK pound will then understand when they are trying to exchange or when they are trying to trade this dollar or UK pound, will then sell it at 15. And this will then somehow reduce its tension in the economy, because you will not anymore demand this currency, and you will maintain your currency because you know that your currency is not going to be affected anymore from this currency for X rate changes, from the foreign currency changes. Unfortunately, this is artificially balancing economy, and when you are letting floating the currency, this will then again negatively affects and cause some negative impact to the economy. But as I mentioned to you, it is somehow helping hand for the short period of time for pegging the currency and not letting the foreign currencies to affect your economy. Because if you are not controlling, if you are not pegging this currency, this foreign currency will become appreciated, because if the currency continuously appreciates and becomes more valued, and your currency will become depreciated and it becomes less valued, then you will continue to demand more foreign currency. And as much as you demand something, its demand cause appreciation and cause the price increase, as in the market. If you buy something, as in the pandemic, the toilet papers and some other necessary foodstuffs become very appreciated because people demanded too much. And when the demand is too high, then the price go up. Similarly, for the currencies is same. When you demand something too much, then it goes up. But therefore, if you peg this currency and if you reduce its price or fix its price, then this will then prevent its value for a certain period of time. And the floating, as I mentioned to you, is somehow letting the currencies to float to the foreign currencies to fluctuate against the other currency, which is the normal structure of the exchange rate market. And managed float regime, which is called dirty float, attempt to influence exchange rate by buying and selling currencies, by buying too much or reducing its value, or by selling it too much for increasing and enlarging. So sorry, for increasing its value by when you are buying and selling it too much to the market for reducing its value. This is somehow when you have something abundant in the market, then this will become cheaper. As in summer, you have watermelon and it is abundantly produced, and its value becomes less. And when you have in winter watermelon, it will become expensive. This is somehow how it is done by this dirty float. The exchange rate regime in the international financial system is, of course, started in gold standards, which was before the World War first in 1914, before 14. The fixed exchange rates was realized by the gold standards. No control over the monetary policy is observed and influenced heavily by production of gold and gold discoveries. And Bretton Woods system is then, of course, then after this, the World War II, after 1945, and maintained until 1970s, the early 70s, the fixed exchange rates using US dollar as reserve currency, which was caused to appreciation of dollar because everybody then started to use dollar, and dollar becomes very appreciated, and it is cancelled results of this appreciation. This is then International Monetary Fund, which is not helping him to control this system. The Bretton Woods system, then again, the World Bank is then used for restructuring and reorganizing everything in the Europa and in the United States for enlarging and maintaining sustainable economical model by using this financial assets and capital. And the General Agreement on Tariff and Trade, which is the GATT, now it is WTO, World Trade Organization, in 1995, is translated and changed the name to the WTO. As you see, the WTO is also attacked in the 2001, I think, in 11 October, 11 September or something. I don't know if you remember this, you probably not remembering, but if you back to the history, you will see how it was affected the world economy, because this General Agreement on Tariff and Trade was planned to reduce the tariff and trade barriers in the economies, in the international markets, for maintaining sustainable economy and helping and for increasing the welfare and letting the poor nations and nations with the abundant factors for producing cheaply and enlarging and exporting their products without any barriers. But unfortunately, after then these attacks and these controls and events in the WTO, this is also not heavily employed, and some other interventions and some other let's say applications, not tariff, not let's say got quotas, but some other phytosanitary measures introduced to the world economy, which is also somehow a restriction to the world nations, to the let's say southern part of the world, who are producing very cheaply, in Mexico, in Brazil, in China, in in the emerging economies, the production is very cheap. But when they are trying to access to the international markets, to the developed nations markets, they are having some phytosanitary measures and some other wrapping, labeling, quality standards. And this has also created some problems to these producers. And results of this, the economy is stagnating again, and it is causing some problems to the world nations, because as much as you are not letting people to export and import bilaterally without any, let's say, tariff and without any restrictions and barriers, this will then good for the welfare, for the consumers' welfare. But on the other side, if you are letting everything free, then this will then create problem, because some tricky businesses may then create or capture the, let's say, the market, and probably the quality standards will then becomes problem. As in the China, you are observing the China Bazaar, the Mr. Pound, this kind of marketing franchising companies are everywhere. The China Bazaar, the China's products everywhere, and they are selling very cheaply, but the quality standards becoming very eligible and very important issue nowadays, because the duration and the standards of this quality and the trademarks are not very heavily used in this production operation process. And this is then the other issue, because while they are reducing the price and the quality, they are able to capture most of the markets, and the people who are buying these products will then after a year buy another one, after 6 months, 1 year, 2 years again, then buy another one. And this then somehow then circulation of the economy will becomes very cheap, and you will then buy always very low quality and very cheap products, but you maintain this production with the consumption which is continuously repeated, and this is then somehow another problem, because when you are buying any trademark products, you will probably use for 10 years, like Mercedes, like Hewlett Packard, like other Siemens, like other, let's say, Chanel, Louis Vuitton, the quality standards, the bags, for example, the briefcases. But when you buy from China Bazaar, then you will use for what? For a year. Then after a year, then it will then require to buy another one. Therefore, this is another big issue in the international market, and this will then create another problem to the exchange rate mechanism, because you continuously require to buy some products, some let's say input, some other materials that you are using in the production operation process. And while you are buying this, then you have to use these foreign currencies for maintaining your production operation process, because you are not able to sell high quality products, and people continuously trying to shop to buy and maintain the standards, because after a year you have to buy another one. Then this will then create a big issue. That's the reason the boom market and marketing, the consumption is very highly expanded, because the quality standards reduced, the prices somehow reduced. I mean, for the high tech products, which is supposed to be, must be high standards. But after a few years, it is then required to change it and replace it with the new one. Therefore, this is the big issue for the economy, because production operation process is becoming very highly expanded. Results of this scale economics, economics of scale, you produce largely, sell it largely, supply is become enlarged, but the consumption is also enlarged, because the duration of the products which is produced and sold is not very heavy and high standards. Therefore, this is another issue. And the European monetary system is also is a fixed exchange rate system institute among the European Union members, exchange rate mechanism which is realized and introduced. And nowadays, after the 2000, they have this euro zone, and then the euro currency introduced and started in the with 15, and then is enlarged into the other countries. And this is then how it is affecting and changing the currency in the international market. This euro, for example, is introduced for removing this dual payments tax and some exchange disparities which is created in the countries. For example, French franc, German mark. When you are going to exchange, then the disparities between the currencies then creates too much to the producers, and this is then now is removed, because they are using this euro currency. But unfortunately, this currency is then having some another problems to maintain its stability for fixing in a certain band for, let's say, 1.5 stay inflation, so-called 40% of the GDP, the borrowing capacity. These things, these standards are not easy to maintain for the member countries in the euro market, in the eurozone. Therefore, this is another issue for maintaining sustainable economical model in the European countries. The Bretton Woods system, as I mentioned to you, it works, but it then collapsed because of these problems that I have mentioned to you. The exchange rate adjustment only when experiencing a fundamental disequilibrium, large persistent deficit in balance of payments, so-called, is becoming questioned. The loans from the IMF to cover loose international reserves. The IMF encourage contractionary monetary policies because of these problems that I mentioned to you in the US dollar, and devaluation only if IMF loans were not sufficient, and no tools for surplus countries is supposed to be issued, and the US could not devaluate currency, then becomes more appreciated. As I mentioned to you, in 70s it then collapsed because the US dollar becomes very appreciated, and this was not good for the US producer, because as much as your currency become appreciated, you are not able to compete with the international market, because your currency becomes very appreciated, becomes very expensive to the producer, to the consumers in the foreign countries. Therefore, you are not able to compete with, for example, emerging economies who are selling for $1 or $2. When you are paying, let's say, $10 per hour, your employee, and your production operation process become very expensive. How you are going to compete and reduce these prices regarding to the China, regarding to the Russia, Brazil, India, and Turkey, Mexico, the emerging economies who are who are producing cheaply and producing and exporting to the other destinations and becoming more competitive in the international market. Therefore, these things become very questionable and very eligible in these international markets. Results of these financial systems, which is not going to be adjusted easily to each other and for balancing and maintaining sustainable economical structure and financial system. The fixed exchange rate regime, when the domestic currency is overvalued, the central bank must purchase domestic currency to keep the exchange rate fixed. It loses international reserves or conduct a devaluation. When the domestic currency is undervalued, then the central bank must sell domestic currency to keep the exchange rate fixed. It gains international reserves, as I mentioned to you in the former slides, and this will then conduct a revaluation. And on the graph we are illustrating, again, I have to enlarge it again for you to see better. You see the slides? Yes. On the graph A, the intervention in the case of an overvalued exchange rate is illustrated, and on the B is undervalued exchange rate illustrated. As you see, on the BA, the exchange rate is overvalued, and as you are observing, the EP, so-called the expected equilibrium, would fall to E1. Then to keep the exchange rate at EP, the central bank purchases domestic currency to shift the demand to the D2. Therefore, the demand will then shift to D2 for maintaining the same level. And on the undervalued, as you are observing, the exchange rate is now undervalued, which means you reduce its value, you estimate its value low. And at a EP, now the price and the equilibrium, the exchange rate where it is realized in the supply and demand in the domestic assets, then shift to the E1 to keep the exchange rate. The central bank sells now domestic currency to shift this demand to the D2, and then the exchange rate will become again to the desired level as it is supposed to be for the underestimated or undervalued exchange rate. Okay, I will then go back to the same. Now you are seeing, I think, isn't it? European monetary system, the 8 members of the European Economic Community fixed exchange rates with one another and floated exchange against the US dollar. This was the planned program for maintaining sustainable economy and currency. The European currency unit, so-called the ECU, value was tied to basket of a specified amount of European currencies fluctuated within this limit, which is balanced in the certain limitation. And this led to foreign exchange crisis involving speculative attacks. To illustrate, consider the market for British pounds in 1992. It is given here, as you are observing, the increase in German interest rates shift the demand curve to the left, as you are observing, then moves from blue to black. And the expectation the British would devaluate shifted the demand curve further to the left because of this unexpected reduction. And results of this, the UK or the British economy is required to greater purchase of the pound to shift the demand curve back to the D1 to keep the exchange rate at EP, so-called the expected level of this currency, which is desired for the maintenance of the sustainable economical and financial system. Here, the policy trilemma is given again. The independent monetary policy is on the right side, the free capital mobility on the mobility on the left side, and on the upper part is the fixed exchange rate, which is given for the Hong Kong, China, and the United States. As you are observing regarding to this trilemma, this triangle which is illustrated, there is almost a similar impact to the each other, which is affecting and changing the impossible trinity, so-called, in the economy. The application, how it is accumulating and realizing the international reserves by using, let's say, China accumulated 4 trillion in international reserves. China rapid growth of productivity accompanied by an inflation rate lower than the US caused the long run value of yuan to increase. The Chinese central bank engaged in massive purchases of US dollar assets to maintain the fixed relationship between the Chinese yuan and the US dollar. And results of this, then monetary unions, a variety of fixed exchange rate regime is monetary currency union, so-called the EMU, which a group of countries decides to adopt a common currency, thereby fixing the currency's exchange rate in relation to each other. This is then the pros and cons, of course, given so-called the positive and negative impacts. The trade across border is easier, becomes easier, as I mentioned to you, because you are removing the barriers, you are reducing these cons, so-called the negativities. The individual countries no longer have their own independent monetary policy, results of this application, which is currently the European Central Bank becomes, after this, of course, which is put into circulation in 2000, it is, of course, becoming more affected. The individual monetary policies for controlling monetary system or inflation, controlling inflation or controlling money supply and the financial system is become more difficult, because you are using the similar currency and you have to control and adopt the rule and regulations of the European Central Bank. And this is then somehow how it is affecting and changing the small economies, especially the smallest countries where mostly affected can be will become more dependent to the larger, so-called Germany, France are becoming the dominant position. That's the reason UK is not becoming part of this Eurozone or Euro, which is EMU is the first application, first model of this introduction. And after this, then this Euro introduced, but the UK economy refused to join this Eurozone, and then totally excluded, as you did the Brexit realized results of these negativities for the UK, because UK pound is very valued and very used currency in Commonwealth countries, and they are having good relations, trade relations, and when they are applying this monetary, let's say, regulations and unions regulations for common agricultural policy, for trade, for agreements, bilateral agreements becomes removed for the UK when they became a member of the European Union. But it is questionable, and it is in international economics issue and subjects that will be introduced to you if you are taking from me the international economics. Will be very detailed introduced to you how it is affecting and changing the economies. But now I don't have any time and any class for these lectures. I am going to give you only the simplest explanation on this issue, which is sometimes good and sometimes not good for the economies. As I mentioned to you, bilateral agreements is removed when you are becoming part of the European Union, and you have to adopt the similar customs union, similar custom tariffs. And this is somehow becomes very important problem for the economies, because some countries will become neglected and will become very negatively affected from these regulations when they are becoming to the member of this European Union, and some countries becoming advantageous because they are having some facilities using from this European Union, let's say, capital and reserves. The managed float, as I mentioned, the hybrid and fixed and flexible, small daily changes in response to market interventions to prevent market force but are not determined solely by them. Appreciation hurts exporters and employment, and depreciation hurts imports and stimulates inflation, as I mentioned to you. The global, will the euro survive? Is always a questionable issue, which is as I already mentioned to you, sometimes it's positively, sometimes negatively affecting the countries, the member countries, especially in the Eurozone, Euro area. The global financial crisis of 2007 and 2009, which is caused the Euro crisis also in 2010 to 2008 to 2010, 11, to economic contraction throughout Europe, with the countries in the southern part, especially in the let's say Portugal, Cyprus, Malta, and some others become affected from this application and from these measures. The adopting easier monetary policy in southern countries to stimulate economic activity is not a possible option, or was not a possible option. This straitjacket effect of the euro has weakened support for the euro in the southern countries and leading to increasing talk about abandoning the euro. As I mentioned to you, because when you are having problem with this euro for maintaining your sustainable economical model and sustainable monetary policy, then you may probably become more advantageous when you abandon this euro in your country. The restrictions on capital mobility can help avoid financial instability. Controls on capital outflows promote financial instability by forcing a devaluation and seldom effective, and may increase capital flight, lead to corruption, lose opportunity to improve the economy. And these are the negatives that I mentioned. And control on capital inflows lead to a lending boom and excessive risk taking by financial intermediaries. These are, as I mentioned to you, the problems of the economies. And controls may block funds for production users and produce sustainable distortion and misallocation and leads corruption. Strong case for improving bank regulation and supervision is subjected. Okay. The role of the IMF, the International Monetary Fund, as I mentioned to you, which is the lender of the last resort for the international communities, it was originally set up under the Bretton Woods system to help countries deal with balance of payments problems, and some bailout programs made and offered by the IMF to helping hand to fix the exchange rate by lending to deficit countries, may be able to prevent contagion or reduced impact. It acts as an international lender of last resort, but this safety net may lead to excessive risk-taking, moral hazard problem. May not be taught enough, not put enough pressure on the governments because of these applications, and austerity programs focus on the tight macroeconomic policies rather than financial reforms, because austerity programs always done for certain period of time, 2 years, 3 years, 5 years, for short to medium period of time, for bailing out the economies who are in risk, who are requiring some problem, require exercise some financial problem crisis. To slow which worsen crisis and increase the cost, countries were restricting borrowing from the IMF until the recent subprime financial crisis. The monetary policy can be affected by international matters in several ways. Balance of payment considerations, current account deficit in the United States suggests the American businesses may be losing the ability to compete because the dollar is too strong. As I mentioned to you, too strong currency is also a problem. You have to maintain sustainable currency for being able to, and it is also not good for them to have some counterparts or the rivals countries, the currency, weaker countries and weaker currencies is also not good for them, because they are having sometimes the advantages in the international markets, as in China observed, become the second best country in the world. The US deficits means surpluses in the other countries and larger increase in their international reserve holdings and world inflation, which is currently we are observing in the world. We have some inflation because of this insufficient resources and insufficient abilities of production operation process. The exchange rate considerations, a contractionary monetary policy will raise the domestic interest rate and strengthen the currency, and expansionary money policy will lower the interest rate and weaken the currency. This is vice versa, because expansionary money policy is somehow you are trying to buy some bonds to enlarge the market, to increase the amount of the money in the system, and contraction, then you sell some bonds. This is how it is realized, and results of this, then you lower the interest rate and weaken the currency. This is then how it is impacted. Exchange rate targeting regime, as I mentioned to you, it is the under the exchange rate targeting regime, the central bank tries to ensure nominal exchange rate stability vis-a-vis the currency of so-called anchor country via interest rate changes and direct foreign exchange interventions. Therefore, importing price stability from the currency from the country is expected. To pick or not to pick the exchange rate targeting, as I mentioned to you, is the issue as an alternative monetary policy strategy. The advantage of exchange rate targeting contributes to keep inflation under control, automatic rule for conduct of monetary policy, simplicity and clarity. And disadvantage of exchange rate targeting cannot respond to domestic shocks, and shocks to anchor country are transmitted, open to speculative attacks on currency, weakens the accountability of policymakers as the exchange rate loses value as a signal. Exchange rate targeting for industrialized countries is desirable if domestic monetary and political institutions are not conducive to good policy making. And other important benefits such as integration arise from this strategy. The exchange rate targeting from emerging markets country is desirable if political and monetary institutions are weak. Strategy becomes the stabilization policy of last resort. As I mentioned to you, the lender of the last resort becomes then this institution. The currency boards, an arrangement in which domestic currency is backed 100% by a foreign currency. Strong commitment to fixed exchange rate by central bank is desired, and solution to lack of transparency and commitment to target. Not issuing authority establishes a fixed exchange rate and stands ready to exchange rate currency at this rate, and money supply can expand only when foreign currency is exchanged for domestic currency. And loss of independent monetary policy and increased exposure to shocks from anchor country. Loss of ability to create money and act as lender of last resort is then subjected. The global Argentina's currency board is another issue, another example, because in Argentina there was always a high inflation. The currency board experiment in Argentina was initially a stagnating success, with inflation falling from 800% in 1990 to less than 5% in 1994, which is very good example for giving how it is realized, how it is done for the inflation. Due to the long-term weakness in Argentina, exports and bad timing, the currency board ultimately ended in widespread violence and bloodshed in January 2002. The dollarization, another solution to lack of transparency and commitment, adoption of another country's money, even stronger commitment mechanism, completely avoids possible of speculative attack on domestic currency, loss of independent monetary policy and increased exposure to shock from anchor country, inability to create money and act as lender of last resort, and lose of seigniorage. This was the presentation for today. As I mentioned to you, I gave you a brief look to this international financial system, and I hope you will enjoy to understand how it is working and how it is affecting and changing the global arena of this exchange rate mechanism and the inflation, which is very important issue because producers mostly affected, but the consumers, the one most affected from inflation, because when the inflation is in the market, the consumers' welfare is transported, some reasonable resources is transferred from consumers to the producers, because consumers in the global arena may be affected, but the producers in global arena is affected from this exchange rate disparities and inflation, but the consumers who are the buyers of these goods and services are heavily affected, and always they are the loser of this game. If you have any question, please ask me. If you don't have, then I will give you some brief look to the material that you are using for your exam, and then I will give you some hints for the final exam, because this is the before last exam, before the last lecture to the final exam. I will tell you, I'm going to upload, I will continue to upload the all materials that I have used for this class to the queues. Then you will download the whole materials. How luckily you will then have the restricted, let's say, materials which is issued and prepared for you. Then you will study this. Then you will then learn and attend to the final exam. As I said to you, as much as you are doing your classes properly, you will successfully finish this course. And if you wish to watch these videos, there is in the Ergin Fikri Akalpler or Professor Ergin Akalpler's YouTube. This is directly related to your courses, to the PhD and master students classes is issued and distributed. All the materials you are observing and collecting from this channel, then you can watch the all videos that I have done until today, and you will learn better, because when you are watching several times, you will then better understand these parts that you are missing. If you do have any question, please ask me. If you don't, then I will finish it here. And as I said to you, I don't know, did I give you any assignment, or until today I didn't, I think, isn't it? Or I have given. Because the queues is not open to the assignments, therefore I am not able to upload the materials to the queues for your assignments only, but for the materials I am able to upload, but for the assignments, the channel and the department is not ready. Therefore, I'm going to give you, if you want now, an assignment, then you will then prepare for me and submit it to the final exam. Do you like it? Do you want me to do this?
No problem, sir. For me,
No
it's
problem.
not a problem.
Okay, then, as you are observing, currently we have done the international financial system. For Sayed, I may require to prepare me the, let's say, 2007 crisis, okay, the financial crisis, which is started in the United States, Lehman Brothers. And you have to, you can write it, okay? You have to give the reason of this crisis. You have to explain me the sanctions which is done for removing this crisis, and how it was impacted and affected the whole countries in the global international markets. And any, you can write me the Bretton Woods system, the whole history, and compare with the euro crisis. Okay, the Bretton Woods and the euro crisis in 2010, 2008 in the European Union, which is affected mostly the southern part of the European Union. And Kevin, if you are also interested, then you will then attend to the, let's say, gold standards. You will write me the gold standards and explain me why it is not successfully maintained these gold standards. How was the extension and impact to the economy, and what was the reason that it is removed, it is not maintained. And if you want to uh, consider, you will then write me the impact and the, let's say, comparison to the similar Lehman Brothers. Okay, the Lehman Brothers crisis, which is started in 2008. The crisis is crisis everywhere. As you see, the financial crisis always affecting and changing the global market currently. And then you will then tell me the impact and the comparison of these two in your assignment. Is that okay? Because I have done the Keynesian model. I have some calculations also, the Keynesian expenditure model. I don't want to give you some calculations, but I want to get some feedback from your writing and knowledge about this economical and financial aspect, because you are the financial students. And if you are creative and contributive to me to write at least 5 pages regarding to your assignments, then I will definitely support you in the final exam. Okay? Is that okay, Kevin, Said, and Annie?
Sir, can you write the assignment for me?
Yes.
Write it and send it for me.
You will
Like
listen. You listen. I have already this is recorded. You will download this YouTube channel and listen and write this. Okay, you can stop and write this all again, because if I'm going to repeat it again, then this will be a problem for you. It is already written already. The transcript also is written. If you want, I can download it and send it to you. But if you are not able to go to the YouTube to see the assignment which is given to you, write me, then I will send you the assignment. Okay? Okay, Said and Kevin. You can do any.
Okay, no
okay.
problem.
Yes. Okay.
If you don't, then if you are not able to download and watch and understand what is really expected from you, write me, then I will send it to you the written assignment. Okay?
Okay, okay.
Okay then. So thank you very much for your attendance and for your joining to the class, and wish you happy new year in 2023, which is going to be in an hours, probably after a day we will attend to the 2023. Maybe you will become more happily, as we are also expecting to become more happily and more let's say prosperity for our all world, isn't it? Because we are having too much problems last 2 years. I hope this year will become more easily and more welfare, because we are having too much crisis and too much economical problems, and this year hope will become less and reduced. Okay then, see you next year. Goodbye.
Bye.
Thank you.